I've learned or just come to accept that buying life insurance is actually against human nature.
Yeah.
Human nature is selfish and self-centered, and a lot of people live in that mentality where it's all about them. But once you have a family and you have responsibilities, then it becomes an important feature.
Check out the website simplepassivecashflow.com for podcasts, videos, articles, and free e-courses. If you guys have any specific questions, feel free to reach out to the team via email, and we'll get you pointed in the right direction, whether it be an educational course or information about syndication deals. If you haven't read my book, The Journey to Simple Passive Cashflow, click the link below to get a free copy. Thanks to John and the Wealth and Freedom Nexus podcast. Our team is here to help you take the first step, or if you're a seasoned investor, then we're here to expand your reach into alternative investing.
For the most passive returns in real estate investing, I like to put my money with Freedom Family Investments, a team I personally trust because they pay me steady streams of cash flow, hassle-free, all while doing the things I love. Returns are better and more reliable than the stock market, up to 12%. I love that tax benefits offset capital gains or your W-2 income. For a little insider pro tip, knowing who to trust is key to success in investing. Freedom Family Investments has a perfect track record of paying their investors right on time. To learn more, text family to 66866. If you want to invest on autopilot with people I personally trust and with a team who cares about you reaching your financial goals, go ahead and text family to 66866.
Are you tired of trying to keep ahead in the rat race, only to have so much of your hard-earned money going to the tax collector? Equity doesn't pay the bills. Retirement savings don't pay you now, and there are only 24 hours in a day to work. The only solution is passive income that pays you 24/7 now, not 40 years from now. From vetted investment opportunities to tax saving strategies, let John guide you through all the confusion and take control of your financial life in pursuit of financial freedom. So sit back, relax, and welcome to the Wealth and Freedom Nexus.
Hello, and welcome back to another great episode of the WFN podcast. Hard to believe this is episode 101. So yeah, for those counting, this is, well, technically 102 episodes, but this is the 101st episode of the Wealth and Freedom Nexus podcast that has dropped every single Wednesday since November, I believe, 4th of 2021. So with the little discrepancy, if anyone is following me along, especially on Spotify or your podcast platform of choice, you'll notice that there's an episode 000, which is basically just a trailer of what people can expect from this podcast, what I'll be producing, and the type of content and guests and financial topics that will be discussed. So if you missed episode 100, be sure to go to your podcast platform, download that. I had a recurring guest, the Cash Flow Ninja, MC Laubscher was on that. I had a very dynamic conversation when it came to Social Security, the insecurity, so to speak, of the Social Security Trust Fund, and hope to have some more podcasts touching base on that topic as well. Like I mentioned last week, I am currently working on a book that just kind of goes on the ins and outs of Social Security, just how it's really kind of set up to fail, blunt, brute honesty with that, just the way it's designed. But politicians, they want to keep getting reelected. They look at the baby boomers and the retirees. That is one of the largest voting blocks. And, oh, gee, boy, if we try to privatize Social Security, we might get voted out of office, or this might not go over very well. Just ask George W. Bush, see how his privatization plan went over so well about almost 2 decades ago. So anyways, moving on from Social Security, I wanted to bring up another topic that I myself have learned a lot about over the years, kind of have a vested interest in it. I've debated about getting my license. I don't know, but really this just comes down to life insurance policies. Now, if you're probably no stranger to my content, and like I mentioned numerous times, if you follow me on Twitter, W Freedom Nexus, the anointed one, Dave Ramsey, who's never wrong, he's actually blocked me, which I thought was kind of funny because I only have about 2,000 followers, but I don't know what post in particular made him say, yep, I'm blocking this guy, but yeah, teach their own, I guess. But if you know Dave Ramsey, you know he just despises whole life insurance. He says, buy term and invest the difference. Just get a term insurance. It's a lot, quote, cheaper than whole life. Whole life is a ripoff. The whole life policies are scams, et cetera, et cetera. And he basically just is comparing apples to oranges. And what I really don't like about Dave is that he just fits this into a one size fits all. This will work for every single one of my millions and millions of listeners, as well as the 330 million people in the United States. This is a one size fits all. Just get term, don't do whole life, and that's the end of it. And sadly, I think so many people just take his advice at face value, whether it's Dave Ramsey or Susie Ortman. I will fully confess I took his advice at face value as more of a, oh, Dave Ramsey says this, well, it's got to be true. So, okay, I'll get term policy, and that's the end of it. And to be fair, I have term policies. I have whole life policies. I have not dabbled in the universal life, index life. That's a whole nother topic and rabbit hole to go down another time. But truthfully, there are a number of stories that I don't think Dave Ramsey wants you to hear where a one size fits all does not apply. And there are instances that a properly structured whole life policy could be the best benefit for someone. Now, I'll go back here, episode, drawing a blank right now. I believe that was with my State Farm agent, Paul McCarthy, episode 81, I believe. Now, interesting side topic with Paul, he had shared with me that he looks at whole life policies is that you're ensuring your insurability. Now, what does that mean? So let's just say you have a newborn child like I did 2 years ago, and you decide, okay, I'm going to get an insurance policy. Well, when they're an infant or a toddler, whole life insurance policies are pretty much the only option. I don't think you can even get a term policy until at least the teens, if not 18, when you're a legal adult. However, you get a whole life policy pretty much from day one. There's no medical exam. There's basically just there's a child, boy, girl, social security number, mom and dad's names. Here we are. Let's set up the bank account to draft the payments, and away you go. So in this case, we actually did what's called the 15 pay for my son soon after he was born. I want to say less than 2 weeks. So basically, we pay the policies for 15 years. At the end of the 15 years, he does have a cash value balance that he can loan out against, use for assets, education, arbitrage, whatever the case may be. But the way it's structured is that once you hit the 15 years that you paid the premiums, then the policy is kind of on autopilot. So after the 15 years, it has grown in cash value with dividends, and the distributions or dividends from the policy actually pay the premiums. So like I said, pay it for 15 years. Once that, let's see if I can do the math in my head, 180th payment is made. After that, it's just on autopilot or pretty much self-sustaining. And then he is insured for the rest of his life, regardless of what happens. Now, I say that of regardless of what happens, and I'm kind of going full circle into my story that Paul shared with me, that say you don't get a whole life policy, say you don't get any life insurance whatsoever, and fast forward a couple of years, that child is diagnosed with Crohn's disease, maybe in early teens, or maybe as a child has cancer, or, as rare as it is, but it happens, think of other catastrophic health issues such as a heart attack, or maybe a stroke, or cerebral palsy, seizures. I'm just naming a couple. That any of these instances, when faced, a lot of insurance companies then won't cover you. Oh, sorry, you have what's called a pre-existing condition. We aren't going to issue you any life insurance policy, whether that's term, whether that's whole life, whatever. Or if we do, it's going to be atrociously expensive for you to even afford it. Insurance companies are in the in the business to make money, just like every other business, and they are looking to make a profit. In order to do that profit, they have to do proper risk mitigation. If they have their actuary tables that shows this individual, age 10, diagnosed with Crohn's disease, and weight this, height this, et cetera, plug in all that data. Well, there is, I'm just pulling numbers off the top of my head, an 80% chance that this child is going to die by age 35. Well, that's a bit of a risk for us, because then we're going to have to pay out at an earlier time. We might not be able to absorb those losses spread out across our portfolio. So we either jack up the premiums, or we just decide, this child, this individual is uninsurable based on our standards, our underwriting criteria. And like I said with Paul, he shared that between his brothers and sisters, there is, might have the numbers off here a little bit, but there are 10 cousins amongst them. So you think of 10 individuals. And by age 13, about half of them, for a variety of reasons, became uninsurable. So they got to the point that, due to a pre-existing condition, seizure, Crohn's disease, cancer, whatever the case may be, one of those pre-existing condition outliers, so to speak, for an individual, the insurance company says, sorry, we can't insure you. And like I said, by getting an insurance policy on someone when they're younger, typically is a lot cheaper than waiting till later, but it ensures their insurability. So if you have a child, and if anyone listening to this is expecting soon, or looking to start a family, or maybe even has young children of their own, you might want to reach out to a qualified life insurance specialist. Like I mentioned before, Barry Brooksby is one of my agents that I've worked with for many years, become a personal friend at Focus Wealth Group. You'll actually be hearing a little mid-roll spot from him later on. But this is just something to keep in mind, that getting an insurance policy, regardless, take away what amount, the terms, that's up to your own discretion, your risk tolerance, what you feel like. But just getting some type of insurance policy on an individual, a child, when they're younger, and then fast forward later, if something happens, they get diagnosed with a disease, diabetes even sometimes, where an insurance company will not underwrite them, that ensures their insurability. So that's just one little tidbit that Dave Ramsey really doesn't talk about, just kind of glosses over. The talk track is, well, if a child passes away, the family, while they're definitely going to be upset and they're going to be sad, it's very traumatic when a young person dies for whatever the case may be. It is sad, but yet, the parents aren't dependent on them. The child is dependent on the parents. So yeah, there might be funeral costs, but unless the child is a Instagram influencer or something like that, typically there isn't a financial hardship versus the emotional hardship. And I would say in about 99% of the cases that would be true. Like I said, unless you have a child model, child actor, whatever the case may be, that they're bringing in a lot of income. One benefit of getting insurance is it's a backstop, or ensures that income stream, where if the person passes away or just gets to a point they can't work, well, if that income stream goes away, you have an insurance policy that can fill in the gaps. So that's just one example. Like I mentioned, ensuring the insurability. So if something later happens on where they're uninsured, the insurance company can't come back and say, you've been paying these premiums for 12 years. Now you have a pre-existing condition. We're just going to void the policy. No, they are locked in. There's a signed contract, provided that all the terms are being met and payments are still being made. The insurance company has to withhold that contract. And then finally, I wanted to reach out with another story. And this kind of brings into my guest that I brought in, Bob Deighton. Now, if you follow me on LinkedIn, Twitter, a number of social media channels, I, relate my experiences with whole life insurance and stories that I've heard. And he had made a post, this is a while back, and I honestly can't remember what the original post started with, but it was kind of stories of, yes, Dave Ramsey says this, however, here's an exception to that rule. And I'll just read this here. I've been in the life insurance business for over 30 years and have plenty of Dave Ramsey stories. One recent one was regarding a 72-year-old man who had $500K 10-year term that was at the end of the term period. Quick little highlight: term insurance, it's set up for a term, whether it's 10, 20, 30 years. You have that insurance during that time. And then once that term expires, then you have to renew that policy, or maybe you're lucky enough to be self-insured at that time. Now, he goes on, and again, this is a very specific instance, but again, shows that one size does not fit all. He had to maintain $500,000 or $500,000 in coverage based on a business loan, and he was shopping for new coverage because the premium was increasing to, catch this, over $35,000 a year. During the conversation, the client mentioned that he was just diagnosed with prostate cancer and was not sure what his treatment options were. Unfortunately for him, he was uninsurable. Again, like I mentioned before, you're insuring your insurability, and whole life insures you for your entire life, whether you live to be 50 or break the Guinness record or you live to be 150. Term life, as it says, is set up for just the term. If you have 10-year term policy and say you get it today here in 2023, you have a 10-year term that you're covered under life insurance from 2023 to 2033, 10-year term. Once that term lapses, you have to either renew or get a new policy. And depending on if your circumstances change, like this individual, oh, you got diagnosed with prostate cancer. Okay, we're not going to deny you coverage, but we're going to jack up your rates. So again, whole life, like my friend Chris Miles mentioned, this was back on episode 40, a whole life gets cheaper as time goes on, where term life gets more expensive as time goes on. You start your whole life policy payment at, day one, that stays the same payment, until the rest of your life. And, like I said, there are some options converting it where the dividends cover the payments. That's another topic. But if you follow inflation, if you know how inflation can be to a benefit, like I mentioned back in episode 32, when it comes to good debt versus bad debt, well, inflation can basically eat away those premiums. So year after year after year after year, that premium payment is going to be getting smaller and smaller on an inflation basis. So anyways, I'm going to go back to the story here. Like I mentioned, unfortunately for him, he was uninsurable and he missed the conversion option at age 70. I asked him why he bought 10-year term, and he said, well, because that is what Dave Ramsey said to do. I then informed him that this was really bad advice based on his age and the length of the loan period. If the treatment of his cancer was successful, he might qualify for new coverage in a couple years. So right there, you're going to have a gap there of when your coverage is. See here, I just missed my spot. Okay. He asked what he should do, and I told him he either needs to refinance his loan and hope the new bank doesn't require life insurance, or pay the renewal premium. And again, this is another tangent. If you've been following interest rates for the last 2 years, we've had the fastest interest rate increase in about 4 decades. So maybe I have no idea. Maybe the business loan was at, 5% and needs to get a new business loan. When now the interest rate's 9%. So it's almost double. So even if you're able to get past this life insurance hurdle, well, now you're paying more for the business loan by changing it over from company A, where I may have a lower interest rate, but they require $500,000 in life insurance coverage, to bank B, where, well, maybe they don't require the life insurance coverage, which is good for me because my term policy lapsed, but now I'm going to be paying 9% interest versus 5%. So again, I just give these that there is not one size fits all. So like I mentioned, he has to either refinance the loan, hope the new bank doesn't require life insurance, or pay the renewal premium, which again went up to over $35,000 a year. That's pretty much a medium, or almost a median full-time salary for some parts of this country here. I also recommended giving Dave Ramsey an honest but negative review online, and warn others that Mr. Ramsey is not the consumer advocate that he claims to be. Conversion options matter. And conversion is basically where if you have a term policy, these are how my term policies are set up, where it has the option to convert to a whole life if I wish to have that option, or if my needs change later on. So I just bring up this story because this really does highlight a story that Dave Ramsey does not want you to hear. And like I shared with my insurance agent, Paul, he's got a story to tell that, Dave Ramsey's advice does not fit everyone every time across the board. This is not a one size fits all. So with that, today's guest is Bob Deighton. He is the president of Deighton Financial Services, LLC. We had a really interesting conversation when it comes to his business, how he got started. He has customers throughout the United States. And again, we just kind of did a little talk track on, just get the other side of the coin. Like Robert Kiyosaki always says, there's three sides to every coin: the heads, the tails, and the edge. And if you're smart, you should be able to stand on the edge and see both sides and come to your own honest, independent thinking for what works best for you. Where unfortunately, so many people are like, oh, Dave Ramsey's on the head side. I got to go over the head side. I'm not even going to listen to anyone else on the tail side. Dave Ramsey is right 100% of the time. And that's the way it is. So again, to today's interview with Bob, after a word from one of our longtime sponsors of this podcast. For investors seeking DSCR financing, check out timothyhero.com. The guy has closed over 150 DSCR loans in the last 2 years and has been appearing on podcasts and written about by journalists. He's well connected with some of the best lenders in the game and can get you the financing for your rental properties. Hey, Bob, thanks for coming on the show. I'm glad we could finally make this work with our schedules and travel plans.
Yeah, thanks, Sean. Thanks for being persistent. I've been really looking forward to doing this. And, I've not had a lot of opportunity to do podcasts, but I'm interested. I'm interested in trying to share our message and share what we do. And some of my experience too, having been in this business for almost 40 years and I'm still a fairly young guy. I'm 59 years old. There's been a lot I've learned and a lot of clients who have been able to help over the years. Life insurance is one of those things you hope you never have to use. But if the worst thing does happen, we're usually somewhere between number 2 and number 5 on the call list when someone passes away. So I've paid, a number of claims over the years, some to very good friends, even, within my own family. So I know what kind of impact having life insurance and the right amount of coverage can have on a family's finances and their future. Because I've learned or just come to accept that buying life insurance is actually against human nature.
Yeah.
Human nature is selfish and self-centered, and a lot of people live in that mentality where it's all about them. But once you have a family and you have responsibilities, then it becomes an important feature to make sure your family's protected, because you're not buying it for yourself. You're buying it for your family. And having been able to step up, for some, widows of very close friends, those were the hardest ones, to deliver. But in retrospect, those funds made all the difference in the world to that family. It didn't help them with the grieving process. It didn't help them get over whatever that it was they went through, but it took away the worry about money and finances and how they were going to pay for things, how they were going to fund things. And that's the uniqueness of what life insurance is. You're paying a very little amount of money for such a huge benefit, and it's tax-free, so you don't even have to deal with the IRS. And there's so many reasons why people should buy life insurance, even if they're not married and don't have kids yet, because there are advantages to locking in rates when you're young, or if you fund it correctly, buying permanent insurance and funding it with enough money where there'll be, a nest egg there in addition to whatever you have for retirement. You can tap for whatever reason. And there's no age restriction. If you're 55 years old and you want to start pulling money out and take early retirement, or use that money to start a business, a second job, second business or something like that, there's that flexibility, and you're not dealing with a bank.
Yep, exactly.
You're dealing with your own bank. You're your own bank if you own permanent life insurance. So yeah, it's been quite a ride. And as I mentioned before, my youngest son is taken to the business, and it's exciting, to have a millennial working with me and, getting their perspective on things. And, my son actually went to the same college I went to, and he did graduate and got a degree, as did my oldest son. So my kids have accomplished some things that I wasn't able to do, at their age. And I was very fortunate that my wife and I were able to help them, financially too, because education is important to our family.
Yeah.
And, I also have a middle son, a third son, who was an auto mechanic, and, he's a mechanic by trade, and he did not like school, but he still educated himself. He went to VOTEC,
Right.
and now he's a power plant operator. And,
Oh, okay.
he runs a methane plant that extracts methane from old landfills. And
Interesting.
they power 30% of the houses in his area, and it's all green. In fact, British
Wow.
Petroleum, BP, just bought out his company, so he's got a great future. He's only 29 years old.
Wow.
So he's in on a ground floor level of a great company that's really stepping up and doing some great things. Not just for their immediate customers, but for the country, because there's this big concern of fossil fuels. And I don't want to get into politics and all that, but for him to be in a company that is doing some innovative things with energy, I'm really proud of him for that, because he was the wild one. He was the one we worried about, but no longer. But anyways, let's get back on topic here.
Yeah, no, and actually interesting you mentioned that's like, wow, that could be a podcast in and of itself of how to fuel 30% of homes in an area from methane / clean energy from a landfill. That's automatically kind of piques my interest right there. So.
Yeah, I'm telling you, it's in, they recruit mechanics,
Okay.
in that industry. If you work for a dealership, there's a pretty low ceiling.
Okay.
And the politics of working at dealerships, was difficult for my son. And he worked at a Lexus dealership and a Jaguar dealership and a Ford dealership. So it wasn't like he was at these used car lots. He was with, some of the best of what's available out there. As far as if you're a mechanic, he was top of the line. And a friend of his approached him about this company, and he took right to it, and he loves working with them, and they're just a good company.
Okay.
They're taking care of him too. But anyways, so back to the Dave Ramsey.
Back to life
story.
insurance and Dave Ramsey. Yeah, now that we've gone on methane and BP. So.
Exactly. So anyways, this call I got, and I've had a few like this. People, when they get older, they just assume that buying term insurance is still a smart thing to do. And it really does have limits. If you want to be covered into your 80s or 90s, term insurance is not going to do that for you. And this gentleman, he owned a business, and he was required to keep life insurance on a loan. He had, I think it was for somewhere around $500,000. And, he bought a 10-year term policy somewhere in his early 60s, thinking that, by the end of this, I'm going to have this loan paid off and I'll be on my way. So 72 years old, I think, when he called, and he had one of the name brand, term companies that are out there and competitive. And he had looked into the conversion option, and he missed that by 2 years, because when he turned 70, that conversion option went away. But his premiums were going from somewhere around $1,500 or $1,800 a year to literally over $30,000 a year to renew that term policy.
Oh, jeez.
And that was really his only option, because he had just been diagnosed with prostate cancer. So if you're 72 years old and you have prostate cancer, you're not going to get life insurance for at least 2 or 3 years.
Yeah.
Because first of all, you have to decide on a treatment plan. I mean, some men opt for removal of the prostate. Some men do the nuclear seeds. That's what my dad did, and it worked fine for him. But until they see that PSA come down and it stays there, and is, if the cancer hasn't metastasized or spread into anywhere else in the body, life insurance companies are not going to take on a risk like that. So unfortunately, I wasn't able to help this gentleman, but he was really at odds. And I asked him, I said, well, so why did you buy 10-year term insurance? And he said, well, that's what Dave Ramsey said to do. And I like, oh, okay. So what did you learn from that? He says, that was really bad advice.
Yeah.
And I agree with him. I said, you probably should have looked at a 15-year term instead of 10, or at the very least been aware of what your conversion options were on that term insurance. But most agents, I would say even over 90% of agents selling life insurance do not talk about conversion options. They don't talk about accelerated benefit riders. They don't talk about these things that are so important, because the reason life insurance is, term insurance in particular, is priced so much cheaper than the death benefit is the life insurance company knows you're probably going to outlive that term period.
Yeah.
So, they talk about renting, you own a policy, but still you're paying for that risk with a little bit of money. But the insurance companies have these people called actuaries who are mathematical wizards, and they crunch the numbers, and they know statistically what are the chances of somebody who is a certain age, certain weight, certain family history, all their lifestyle, options, smoking and skydiving and scuba diving and all these things that
motorcycle, daredevil, driving, whatnot.
And I've dealt with a lot of them. I have some helicopter pilots, so I've written a lot of pilots over the years. And, personally, I think I've only been in a helicopter a couple times, like in Hawaii on a convention or something. And I don't think I'd ever get in a helicopter again, looking at the stats, because they are by far the most dangerous aircraft, other than experimental aircraft, that you can get into, because there's no soft landings with the helicopters. Even if you're 50 yards in the air, is still, you're going to land pretty hard. But all these risks, are looked at by insurance companies, and, they have to win most of the time, or else they wouldn't be in business,
Exactly.
So you're paying a little bit of money for a big benefit. And I can't think of another financial product or product in general that provides so much for such a little amount of money. And that's what makes this business so unique, is we get to provide something that most people want to avoid. Like I mentioned earlier, the self-centered nature of human beings is to, serve their own interest, to just focus on themselves. But once you have responsibilities in a family, that changes, and you have to get over that fear that, someone's going to be rewarded or get money upon your demise, that, and it's subconscious. It's not like people consciously think about these things. When our kids were growing up, we had some friends who had 3 boys the same age as our boys, and my wife became best friends with this lady, and I became really good friends with her husband. And when he asked me what I did, I said, well, I sell life insurance. And he said, life insurance? Should I waste money on life insurance? And I had to explain to him what it was I did. Now, he never did buy a policy from me, but I wasn't really trying. I mean, when it's close friends and family or people that I don't know well, I don't want to jeopardize that relationship over something that they're absolutely not interested in. I mean, I can drop subtle hints. I can give them examples or whatever, but ultimately, there's going to be a percentage of people, I don't care what you tell them or how good you are presenting something or closing a deal. There are some people that just will not do it because they can't get over that self-centered fear, and they're stuck in that, which is unfortunate, because the dad is still alive, and we're still friends. And he's lived now into his 60s, and his kids are grown, so he doesn't need a lot of life insurance. But still, that was just one glaring example that kind of jumped out at me. I didn't know people thought that way. I didn't know that there was such a huge resistance just from a subconscious standpoint, because I'm sure he didn't think it through before he made that comment. Like, he didn't really think about what he was saying. It was just a natural response for him. And I don't judge him for that, but that's what we're up against in this business. There is a lot of, resistance. And then you have all these so-called experts like Ramsey and others who do really a half-assed job of explaining things. They keep it simple enough where they seem like they have credibility to gain someone's trust, but then they leave out a lot of the important information, like underwriting. Everybody goes online and sees the preferred plus, and they assume they're going to get those rates. I would say 8 out of 10 people we encounter, the truth is maybe 2 or 3 out of 10, depending on what age group, and as you get older, that percentage goes down. The number of people who are going to qualify for those rates that are advertised out there, you see, get $1 million for $10 a month. But that's on a 23-year-old female who's in perfect health and has good family history. So there's a lot of bait and switch, a lot of, misleading advertising and, marketing that unfortunately gives us all, a bad name or a bad impression on the public. And that's why I've tried to do things somewhat different and take an educational approach. And it doesn't always work, but you know what? It works well enough for me. And I've been able to make a really good living for my family over the years and, do fun stuff, great vacations, and also help my kids get educated and get experiences that otherwise, if we didn't have the funds to do that, they wouldn't have those experiences. And I think it's really helped them as adults because, they understand the world better. If you get out into the world, you'll understand it better. If you sit in your house and play video games all day, that's not reality,
Exactly.
But anyways, so, there are a lot of, so-called experts out there and some of them actually provide some good advice, but there aren't many that go into the kind of detail or the topics that I like to talk about. There are people who call me and say, hey, I want to buy an IUL. We're being, pitched on it by somebody. And I'll ask, well, why do you want an IUL? I said, well, because this guy said I'm going to have a pile of money. I can take loans. I can do this. And I said, well, okay, but really, why are you doing it? What's the real reason? And it's really because they were sold something. They were sold an idea. They were sold a concept. They were sold on a spreadsheet where only a third of the information that was supposed to be provided was provided. And, I'll tell them the whole story. I own IULs myself. And if you were to ask most insurance agents what they personally own, I guarantee you less than 20% own an IUL that are selling it or a whole life policy. So a lot of people, if you don't own it and you're selling it, shame on you.
Exactly.
Because if you don't believe in it enough to put your own money into it, then, you need to check yourself, But anyways.
No, and on that note, you actually brought up a number of good points, Bob. And on my show here, the Wealth and Freedom Nexus podcast, I've had other guests on where we talk about whole life insurance and even term insurance. It's, relatively low. It's good for a term of 10, 15, 20, whatever years. And in many cases, I think that's a decent start for many people, especially if you're young, just starting kids. It's like, hey, I can't afford, pick a number, $200 a month, but I can afford $25 a month, whatever the case may be. You had mentioned about convertible, and unfortunately, your one client that called missed their conversion window, and it went from, what was it, $1,800 to $30,000 a year. But what exactly is that? I mean, I know what it is, but for my listeners that are not familiar, what is that convertible term policy, or how does that exactly work?
Right. Great question and very important question.
Hey, everyone. John Ritgarn here. Do you want to grow your money guaranteed and tax-free and have access to liquid cash for real estate investing? Infinite banking, high cash value, whole life policies allow you to grow money guaranteed and tax-free. See what the infinite banking concept will do for you. Reach out to Barry Brooksby, the infinite banking expert, to see your own numbers. His email is barry@focuswealthgroup.com. Barry is a personal friend of mine who's helped me over the past 7 years. He'll teach you how to grow more wealth, guaranteed and tax-free. Email him at barry@focuswealthgroup.com or go to wealthandfreedomnexus.com/infinite banking.
When I brought up how inexpensive life insurance is compared to the death benefit, there's a reason for that, right? Okay, it's all about numbers. The chances are you're going to outlive a term policy, and that's why it's cheap, okay? But at some point, you may want to convert some of that coverage from term into permanent. By permanent, I mean indexed universal life, fixed universal life, or whole life. Those are basically your choices. Not many people buy variable life anymore. And I'm not going to talk about that because it's a securities product. And
sure,
I don't work in that industry, but convertibility, the main advantage is it ensures your insurability in the future. So when you're young and healthy and, you can qualify for a preferred or preferred plus rate class, from a percentage standpoint, that can be half the cost of a standard rate class or standard non-tobacco rate class on term and permanent insurance. So when you're locking in a term policy and you qualified for that cheapest or second to cheapest rate class, your pricing is going to be very affordable. You can buy, say, a 20-year term for, $2 million for $50 a month or $70 a month, somewhere in that range if you're healthy. Now, as you go on in life, at some point, and some term policies allow you to convert, up to a certain age or up to a certain time period. So what I've seen some companies doing is they'll, on their base policy, allow conversion the first 10 years. But they also offer a conversion to 20 years, but you have to pay extra for it. So you have to pay like an extra $100 a year to have that right to convert your term till the end of the term. Now, some companies have even really made it confusing where they make it, 12 years or 18 years or some odd number. But that number is very important because let's say you have a 20-year policy and you are in year 18 or 19 and you're suddenly diagnosed with cancer, or you have a heart attack and you get a couple stents put in. You're no longer preferred plus or even preferred or even standard. Okay. If you try to buy new life insurance at the end of that term, you're going to be rated very highly, if you're lucky to get coverage at all. So you can convert, as long as you have a conversion option, you can convert all or part of your existing term insurance to a permanent policy, which is going to be much cheaper than trying to buy new life insurance, whether it be term or permanent insurance, because that conversion is guaranteed at the same underwriting class that you qualified for on the original term policy. So if you're preferred plus, you're 50% cheaper than standard. When you're in your 50s, not a lot of people in their 50s get preferred plus anymore. So if you apply for an IUL outside of a conversion and go through full underwriting, you might end up at standard. Chances are you will be. Now, the cost of the policy, be it, their monthly cost of insurance, whatever fees they have, is mostly based on what risk class that you qualified for at that time. So if you're in your 50s and you're applying for a new policy and you can't qualify for the cheaper pricing, your best bet is just convert some of your existing term insurance to a permanent policy if the company you bought term from offers competitive term or competitive permanent policies. And unfortunately, most of them don't. So there's really, and I've been doing this long enough where I have an ongoing list of companies that, we've sold term policies for, where we've done conversions, instead of just talking about, we've actually done conversions and we've seen, the differences between the companies. And it is amazing how different. I'll give you one example. A couple of years ago, I had a client who bought term from one company for $1 million and then term from another company, and he bought both policies from me, but for whatever reason he wanted two different companies. So he gets to the end of the term, and he was preferred plus back then, and now he's in his early 60s and he's type 2 diabetic. His BMI is beyond what they allow for a preferred plus, but as soon as your diabetes is in the picture, you're standard at best. So he got conversion quotes from both companies, and one company was double the cost for a permanent policy over the other one. Yeah, double the cost and they were both universal life policies, same rate class, preferred plus, but the first company just didn't offer their most competitive products for conversion. And that is the case 90+% of the time when people are buying term insurance, and they just don't know it. You know what? Agents don't know it. Either they don't know it or they don't care, or they haven't taken the time to actually read a policy, or ask the question, okay, so which products can my clients convert to if they're buying term insurance? And these are really important features, because the chances are you're going to live. And that's the good news. The chances are you're going to outlive that term policy, and you're probably still going to want or need life insurance, when you're in your 50s or 60s. Generally, there's few policies that will let you convert past the age of 70.
Okay.
I have some clients that are on term insurance policies where if they want to wait till they're 74, they can. I don't recommend that because if they wait that long, it's going to be very expensive, to convert, even if it's a competitive product. So ideally, the best time to convert, if you're going to do a conversion policy, is somewhere in your late 40s to mid 50s. I would say, early 60s, really at the latest. My wife and I converted some of our term insurance a few years ago into an IUL, and I diversified among two different indexed accounts. One of the accounts, we just got lucky. It was nothing on my part that I just, looked at the track record, said, well, this one looks good. This one looks good. We earned over 30% interest on one of those accounts the first year.
Wow.
Yeah. And the other one was still around 10%. So here between those two accounts, we earned about 15%, 20%, about 20% average between the two. And what was nice is once that money was earned and it's deposited into the cash value account, the next year, of course, this last few years, we've seen a decline, in equities in the stock market. So the second year, we didn't earn any interest, but we didn't lose any value.
Sure.
And that's one of the beautiful aspects of an IUL is you participate in the growth, but you don't get penalized with any of the downside. So there's no downside market risk. And that's a huge benefit over time because, I did sell mutual funds. I did sell variable products, up until like the late 90s. And one of the worst calls you'll ever get in this business is from a client who says, why did I lose money?
Yep, exactly.
Even if you explained it right and you told them all the risk going in, that is, the last phone call you want to deal with. And of course, we know the real reason. If you're going to be in something that has risk, you have to be committed to it long term. You know? And when IULs came out, honestly, I just let go of my securities license. I said, this is the answer because, there's a lot of potential liability that comes with that license and cost. I mean, just to get E&O insurance for just a Series 6, it's ridiculous. And honestly, I wasn't making that much money selling mutual funds and securities. So I figured, hey, this is a much better product for my clients and a much smarter business model for me to work in versus carrying all this additional, responsibility and, compliance issues, dealing with the SEC and organizations like that. It used to be NASDAQ or now it's FINRA. I can't remember what they used to call it, but it's a group of people just looking to, penalize you for really minor, sometimes honest mistakes,
Right.
And they usually don't do that to the big, bankers,
big players. Yeah,
exactly. They just look to make examples out of people. And then I saw some of that going on and I'm like, this doesn't make sense.
Yeah.
So anyways, the industry really has evolved, and one other thing I want to mention, our accelerated benefit riders, this is something that is way under promoted. I don't know why life insurance companies don't, you explain this stuff in commercials or at least put it out there. But these are provisions in a life insurance policy where you can collect money against a death benefit while you're living. You don't have to die to collect. Now, you're familiar with what I'm talking about? Accelerated benefit riders, like a terminal illness rider?
Yeah, I know the gist of it. Basically, you have a death benefit, but you can basically pull from it. I consider like a HELOC almost while you're still alive, for analogy I can give, I'd say.
Exactly. So terminal illness riders came about from the AIDS crisis.
Okay.
So, viacular settlements, all right, where people sell their life insurance policy to investors for 10 to 20 cents on the dollar. Okay. And there are companies that advertise on AM radio to buy people's life insurance policies who are in their 70s or 80s.
Yep.
Now that would make me uncomfortable.
Yep.
Not knowing who's the beneficiary and owner of my policy, because who knows, what they're really up to, but it's an industry and the life insurance companies do not like it. And that's why on every application, there's a question, do you intend to transfer ownership of your policy, to someone who you're not related to, basically, or has an insurable interest? So back when, the AIDS problem came up, people were doing that. They were desperate to get money to get these experimental treatments because health insurance didn't cover it. So this industry blossomed from someone else's, problems. And, so life insurance companies introduced the first accelerated benefit rider called the terminal illness rider, probably back in the late 90s, early 2000s.
Okay.
And this rider allows someone to accelerate a percentage or a certain amount of their death benefit and collect while they're living. And it's discounted usually by about 15% on the average. So if you
Okay.
accelerate 100,000, you're going to get around 85K. Or if you have a
Okay.
million, you're going to get about 850,000. Now, what's great about this is you get it tax-free, number one. It's still
Okay.
a tax-free benefit. And number two, if you live another 20 years, you never have to pay it back. And they just keep the remaining amount of life insurance in force, and they adjust their premium down to whatever that amount costs on if it's a term policy or a universal or a whole life policy. So that particular benefit's been around for a while. Now, in the last 10, 15 years, there's been a few companies that have introduced a critical illness rider, which basically is the same idea, except you don't have to have such a short life expectancy, because with a terminal illness rider, the life expectancy on average is 12 months. So you have to get a pretty bad diagnosis. Some companies are 6 months. There's a few companies that are 24 months on the life expectancy. So the longer the life expectancy, the more liberal they are with how much money they're going to send you.
Okay.
So how you can qualify for it. So a 24-month life expectancy is much better than a 6-month, because if you have 24 months to live, you can take some of that money and go get treatment somewhere else, something that's not FDA approved, that's maybe in another country, that's worked for other people. So there have been some cases, and I don't have anything in writing of this, it's all been like word of mouth, but there have been cases where people have used this money to get life-saving treatment or life-extending treatment that, from going from a 1 or 2 year life expectancy to like a 10 or a 15 or a 20-year life expectancy. And you don't have to pay that money back. And to me, that's really life insurance. There was a book written many, many years ago called The Mortality Merchants. And I don't remember the author, but he referred to it as death insurance. And that's really what life insurance is, because it pays when you die. But if you can collect money while you're alive, maybe save your life or extend your life, give you a better quality of life, do something with your family, to me, that's real life insurance, because you're insuring the way you live. You're insuring your lifestyle. Now, the critical illness rider is just it's a similar type of rider as terminal illness, but it's very specific. You have to have a heart attack, stroke, cancer, or need, and some policies are a little bit different, but some of them throw in major organ transplant. So if you go to a major organ transplant, you can accelerate, a portion of the death benefit. We have some companies that go up to $1 million of the death benefit you can accelerate. So you could literally collect somewhere between $500,000 to say 900,000 while you're living for a moderate to severe critical illness. Now, what's the number one cause of death in the United States? Heart disease. So, right? So if you're a male in particular, and you're between the ages of 50 and 70, that's when most males have heart attacks, but most people survive. If you get treatment, and I have friends that have experienced this, where they had a widowmaker, which means their main artery to their heart was 90% blocked or more. If they make it to the emergency room, within 2 hours, they'll have a stent in there, which clears the pathway. So now your heart's going to be, and if there's not much heart damage, you almost go back to, as long as you're not diabetic or have some other health history, you get close to back to normal mortality tables. And to be able to collect $500,000, now you're going to have to give up $1 million of your term insurance to get the $500,000, or give up $1 million to get maybe 700,000 or 800,000. I mean, top end would be like maybe 850 to 900, but what a benefit. And the difference in cost for a term policy that has that benefit versus one that doesn't is less than 10 or 20%. But agents don't talk about this stuff, and the consumer's not going to know, because the companies aren't advertising it. Now, there's a third accelerated benefit rider called a chronic illness rider. Now, you can buy this on term insurance. There's a lot of permanent policies that include it now. It's basically another word for long-term care. So usually it's a percentage of the death benefit you can collect each year, if you can't perform 2 of 6 activities of daily
Mhm.
living,
Feeding or
have
bathing, or I can't remember off the top of my head.
right, feeding, bathing, dressing, continence, which is separate from going to the bathroom for some reason. I don't know why, but that's the way they
Interesting.
list it. Or walking. So 2 of
Okay.
those 6 things are qualifying events that you can qualify for this benefit, not just on a life insurance policy, but on a long-term care policy. But that's a whole nother topic. I see more people buying life insurance policies with these riders versus
Mhm.
buying long-term care insurance.
Well, so many are getting out of the business. They're not offering long-term care insurance because people are living longer, and it's $3, $5, $10,000 a month for care.
It's ridiculous. I went through it with my mom. My mom
Mhm.
in her 60s or early 60s bought long-term care insurance. And by the time she was in her early to mid 70s, we knew something was wrong. And she had Parkinson's disease with dementia. So
Jeez.
horrible disease. And I was her, go-to person. I managed her life for 5 or 6 years, took her to all her medical appointments and, got her properly diagnosed. And eventually, she had to go into assisted living because she was, her memory was getting bad. Her driving was getting really bad, which honestly never was that good to begin with. But, she was, she really needed hands-on care, 24/7. So she
Okay.
was in a assisted living facility, really one of the nicest ones in where we live in Sarasota, at $6,000 a month. Plus a
Jeez.
$20,000 sign-on fee. So
Yep.
just to get her in there was $20,000 plus a $6,000 a month. Now, between when
Wow.
my mom bought her long-term care policy and when we actually used it, the premiums had gone up about 35%. While she was on claim, we didn't have to pay the premiums, but one year we got a renewal notice that this particular company was raising rates by 98% 1 year, and the state of Florida approved that rate increase.
Wow.
So all those other policyholders in Florida
Jeez.
who are probably in their 70s or 80s are now having to spend double to get the same benefits. And I
Jeez.
hear these stories from all over the country. So, and that's one of the reasons why we kind of get into the hybrid insurance that combines, and there are true hybrid policies that combine, permanent policy with a long-term care account, and it's based on a daily or a monthly benefit, and you can have inflation riders and all the other stuff, just like a regular long-term care policy. But then you have a lot of these other policies where they use chronic illness as the terminology.
Okay.
And, I can go into some details. I don't know how much time we have, but basically, if you're buying a policy that is based on a long-term care platform, you're probably dealing with a reimbursement type of claim situation. And that's what my mom had. So what we had to do is pay the $6,000 every month, submit the bill to the insurance company to get reimbursed. It's called
kind of like a
reimbursement.
health savings account almost, how it just reimburses you.
Exactly. But there's more work involved. And I've heard some horror stories that, from people I've talked to where the companies were dragging their feet on reimbursing the money, or they weren't approving the healthcare provider or the type of care that the person needed. So, there are some strings attached to those type of situations where the caregiver has to be approved, the facility has to be approved. Now, if you go the other route, we go with a plan that has the chronic illness benefit. The majority of those work on a indemnity basis, meaning once you qualify for the benefit, they send you a check for the year's benefit or the month's benefit, and you do whatever you want with that money. That means you can pay a family member, you can pay a neighbor, you can just hire your own caregiver to do the work and negotiate, maybe a little bit better deal on the cost of care. So the indemnity payout is such a better deal, even though like the premiums may be a little bit higher or the payout may not be as high as a reimbursement. That gives you control over those claims dollars.
Sure.
And I've found that to be a really important feature. And a lot of the permanent products include that now, either at an additional cost or they do it at no cost. But what they do is they discount the payout maybe by 10 or 15%, similar like the terminal illness, where it's not a dollar for dollar exchange. So if you accelerate $10,000 of your benefit of your death benefit, you're going to get maybe 8,000 or 8,500. So, but the fact that you can do whatever you want with that money and control it gives you more power, and it's less paperwork. You don't have to
Sure.
file for reimbursement every month. So I think these features are all extremely important to explain to people, to let them know how this stuff works. Now, they're probably going to forget it within a week or two or a day or two, but at least you've done your job,
Right.
and you point out in the illustrations where all this is laid out. So when it comes claim time, they're going to know more of what to do, whether you're still in the business or not,
Right.
and there again, we're in the sales business, but I think if you're doing a good job educating your clients and letting them know, here's one way to go, here's another way to go, giving them more
Yeah.
than one choice, and not too many choices too, because as a professional, I have to, put myself in their shoes and say, okay, if I were to try to solve this problem, what would be
Mhm.
my best two options? And that's how I present things to people. So if I were
Sure.
to, with all my years and knowledge and experience in this, what would I do personally? And that's how I take it to a potential client or even an existing client,
Yeah.
Um,
Well, I think I kind of echo your sentiments with there. I'm all about choices. I don't think there's any one size fits all, buy term, invest the difference. That's going to work for anyone, everyone, regardless of their situation and whatnot. All of us are unique. All of us are in different situations. And, I've taken a bunch of notes here. I didn't even know about all these, riders that you mentioned and all these options as well. Maybe in closing, Baba, before we get to, where people can, find out about you and your business and, your son taking over, do you, is there like one, I know you shared the one story already with the guy missing in the conversion, but any other story that maybe pops in your head or is top of mind that this is really an anti-Dave Ramsey story that he doesn't want you to know about, but in this
Right.
instance, it didn't work out that well or whatever.
Right. Well, I kind of flipped that a little bit. So I had a client who I was showing some term rates to,
Okay.
and I was showing him like 10, 15, 20-year term. And I think when he bought the policy from me, he was maybe in his late 40s, early 50s. And he kept looking at the renewal rates on the term. And he was shocked at what the renewal
Yep.
rates. I mean, just shocked. And I do that on purpose so people know the truth. When you buy
Yep.
term insurance, and if it doesn't have a conversion option, this is what you're stuck with.
Right.
So he said, "Isn't there anything I can get that will guarantee a rate for the rest of my life?" I said, "Sure." So we can look at universal life and look at whole life. He says, "Which is the cheapest? Which is the one that
Yeah.
is going to fit my budget?" And his budget was maybe $250 a month.
Okay.
So I was able to write him a $250,000 universal life policy, and it had that chronic illness rider. And this was
Okay.
about the time where companies were just starting to add that on there. So
Okay.
I'm going back to like 2005, somewhere in that range.
Okay.
So if he had taken Dave Ramsey's, advice, he would have bought a 10-year term.
Yeah.
And then in 10 years, if he was still insurable, he would have tried to buy another 10-year term and go through the whole, requalifying issue again. But he kind of knew what he wanted. And I didn't even, I might have mentioned the chronic illness rider, but some years go by. He's now in his 70s. And I get a call from his sister, and she says, and I think the cash value was only like $7,000 or $8,000. It was, it wasn't anything significant.
Sure.
He was funding it just to have a guaranteed policy.
Yeah.
So she said, my brother is going to apply for Medicaid, okay, and try to get the government to pay for his care. He has same thing my mom had, Parkinson's with dementia, early 70s. And I said, well, before you do that, before I send you the cash surrender form, let me call the insurance company and see if it has this one rider on there, because I think it might.
Okay.
So I found out, I confirmed he had the chronic illness rider. And I called them back, and they were both on the phone with me. And I said, listen, you have another option. You don't have to go on Medicaid, because he still owned a house. He still had some assets.
Yeah. Medicaid spend down, wipe out everything.
Exactly. He was about to give up everything he had worked his whole life for, to Medicaid, to the government.
Yeah.
And if you die like 3 months later, they don't give it back.
No, of course not.
So do you really want to give your government your money that you worked hard for? Said, here's another option. You can accelerate your death benefit, which was $250, and the net payout was somewhere around $40,000.
Okay.
Which was about what the cost was for his care for that year.
Okay.
So I said, go ahead and apply for it. They'll get his medical records, and they did. I mean, they got a check, and I think they're now on year 4.
Okay.
where they have now gotten close to somewhere around 180,000 from this
Sure.
policy, and he still has some life insurance, hasn't been paying any premiums. So when you qualify for these benefits, once 90 days goes by, they waive all the costs on the policy.
Okay.
So if this guy had taken Dave Ramsey's advice, guess who would have got his money?
Dave Ramsey? No, just kidding.
No, the government.
Yeah.
The government would have taken all his money.
Jeez.
And just to get them to pay for, probably not the best, assisted living facility,
Yeah.
because the best ones don't take Medicaid patients.
Exactly.
So this gave them some more choice on which type of facility, what kind of care, how close was it to his sister's house. So they had more choice because they had cash in hand. It was an indemnity payout. That insurance company sent that money directly to them. And while I was on the phone with him, he broke down and started crying.
Wow.
And he said, I finally did something right. And if I hadn't taken the time to make that phone call or care enough about that client, he would have lost everything.
Exactly.
Or his family would have lost it. So I've been in contact with his sister, and he's doing okay. But, that's just one example right there why, just going on blind faith of some so-called expert could cost you everything.
Exactly.
And
like you said, you give that all to the government, you die 6 months later, the government's not going to give that back. They're like, oh, I'm sorry.
Exactly. It's like a life annuity.
Yeah.
With a, no survivorship benefits. So,
yeah.
So that, like I said, I've learned a lot over the years, but that's one that I'm really proud of. I'm really happy for, I'm not happy when the guy gets sick and
right, but
care, but
that you could help them in a way that they didn't know about. Exactly. So
exactly. So
all right.
like it.
So, well, as we close this out, Bob, and again, I want to, thank you for the time taking out of your schedule. Glad we could finally make this work. And you and I connected on LinkedIn, and I think both you and I are kind of maybe not anti Dave Ramsey's, but maybe let's get the full picture about Dave Ramsey, so to speak.
Yeah, and,
but,
and not just him. I mean, there's plenty of them out there that are posing as experts, and they don't really do their homework.
Exactly.
Because if Dave Ramsey did his homework, he would be talking about these types of things and what a value that is.
Exactly. So now, anyone out there that's listening to this, maybe unfortunately took Dave Ramsey's advice, maybe they're finding themselves in a difficult situation, or maybe, gosh, there's something different out there than just term or whole life or anything like that, and maybe has some additional questions, maybe needs or wants a policy review. What's the best way to reach out to you and your company, or if your son, if he's taken over? So
right, and he's not taking it over yet. I'll be clear about that.
All right.
I don't have a set retirement date at this point, but yeah, I put it this way: he's working mostly new leads, and I'm working mostly with existing clients.
Okay, gotcha.
But if someone wants to talk to me, I'm happy to talk to them. We have a toll-free number they can call, but really it's better to call my cell. My cell phone is 941-685-8854. Or if they're on a landline, they can call our toll-free number, which is 866-365-6558. And if you go to DeightonFinancial.com. So it's my last name, financial.com. We have a quoting engine on our website where you can run your own term quotes.
Oh, okay.
You can get a free copy of our guide called An Insider's Guide to Buying Life Insurance. It's a PDF format. You can download to your computer for free. It's trademarked and copywritten. So if you want to steal it, I'll sue you.
Okay. I'll put that in the show notes. Do not copy
But because, it's interesting. I've been working on this guide for the past 20 years. And I started to see some of my verbiage show up on people's websites and marketing pieces. So I said, I need to get this copywritten. And so that's what we did. And I'm really proud of it. And actually, my son, Jack, wrote his thesis paper on life insurance. And we took part of that and made it the forward of our guide. So it's not just me. My son, Jack, actually wrote the forward part on that. So, family thing going on, and really proud of my sons.
All right. Sounds good. So for all those listening, I'll have those numbers in the show notes. Otherwise, you can just go to DeightonFinancial.com, download the guide and run your term numbers and start a conversation. So with that, Bob, it's been great to finally connect, and I wish you the best on your upcoming retirement years and all your success you've had with your business.
All right. Thanks so much, John. Appreciate it.
Thank you for listening. Be sure to share, rate, review, and subscribe on your favorite podcast platform. For more updates, check out www.wealthandfreedomnexus.com. Remember, nothing on this show should be considered tax, legal, investment, or professional advice. This show is produced solely for educational and informational purposes. Please consult an appropriate and licensed tax, legal, real estate, or business professional for specific advice for your situation. For distribution or publication rights or media interviews, please contact the host.